The charts are flashing red. On-chain activity has hit a 5-year low, and some of the world's top crypto analysts are now warning that Bitcoin could be heading for its biggest crash since 2021. Could the world's #1 cryptocurrency really fall by as much as 80%, just when everyone thought the bull market was back? Stay tuned, because what's happened behind the scenes might shock even the most loyal Bitcoin believers. Over the past few weeks, Bitcoin's price surged past $120,000, fueling excitement that a new all-time high was within reach. But beneath the surface, the data tells a different story. Analysts like Willy and several on-chain experts have pointed to a massive drop in blockchain activity, fewer active wallets, and a suspicious rise in whale dormancy, meaning big holders are suddenly on the move after staying quiet for months. Combined with rising liquidation pressure, AI-driven market speculation, and global liquidity tightening, many now fear a correction that could wipe out trillions in market value, echoing the painful crash of 2022. The question is, are we standing at the edge of another crypto collapse? Or is this just the calm before a major breakout? Before you make your next crypto move, make sure you're subscribed, because in the next video, we'll reveal the 3 key signals that can confirm whether this crash is truly coming or just another fake out. Drop your thoughts in the comments. Do you believe Bitcoin will survive the storm? And as always, stay smart, stay safe, and stay ahead of the markets. It started like every classic Bitcoin rally. Quietly, then all at once. Early 2025 saw Bitcoin climbing steadily past $70,000, then $90,000, and by August, it broke the long-awaited $100,000 mark. Crypto Twitter exploded. Memes returned. Influencers shouted supercycle confirmed. And mainstream investors rushed in, afraid to miss out. Even big institutions, from BlackRock's ETF clients to Asian hedge funds, poured in billions. Analysts began predicting $150,000 to $200,000 before year-end. It felt unstoppable. But as history has taught us, when everyone believes it can't go down, that's when danger starts to build. The first cracks appeared beneath the surface. Despite record prices, on-chain activity began to decline. Data from Glassnode showed active Bitcoin addresses had dropped nearly 30% since June. That meant fewer unique users were transacting, even as price soared. Normally, in a healthy bull market, both price and on-chain usage rise together. This time, they were diverging, a silent warning few wanted to hear. Then came the whales, Bitcoin holders with tens of thousands of BTC. For months, they'd been silent. But in late September, trackers noticed large dormant wallets suddenly moving funds. Hundreds of millions of dollars in BTC were sent to exchanges, often a precursor to selling. It wasn't just one or two whales. It was a pattern. On-chain expert Ki Young Ju posted data showing massive spikes in exchange inflows. In the past, these spikes have always preceded market corrections. Meanwhile, funding rates in futures markets skyrocketed. Everyone was over-leveraged, betting on higher prices. And that's exactly the setup that leads to liquidation cascades, where one big dip triggers millions in 4 sell-offs. But retail investors didn't care. They were still celebrating Bitcoin season. Crypto influencers promised $250,000 before Christmas. Even mainstream outlets like CNBC started talking about Bitcoin's new era. Behind the hype, though, experienced traders saw the truth. Liquidity was thinning, whales were restless, and sentiment was euphoric, a dangerous combination. As October approached, one message became clear. Bitcoin's rise was built on excitement, not stability. And every bull run built on hype has an expiration date. By early October 2025, Bitcoin hovered between $118,000 and $125,000. The charts looked stable, too stable. Then the warnings began piling up. The first came from derivatives data. Open interest, the total value of active futures contracts, hit an all-time high. Traders were using up to 100x leverage on major exchanges. That meant even a 1% dip could trigger mass liquidations. On October 3rd, it happened. Bitcoin plunged from $125,000 to $115,000 in less than 6 hours. Over $2 billion in leveraged positions vanished. The so-called funding flush left the market shaken, but analysts called it a healthy reset. Except it wasn't. Behind the scenes, AI-driven trading algorithms were amplifying volatility. Hedge funds and quant firms had deployed models that traded Bitcoin based on social sentiment, macroeconomic data, and liquidity levels. When volatility increased, the bots didn't stabilize the market. They accelerated the moves. Meanwhile, on-chain activity kept falling. Transaction count, wallet activity, miner revenue, all dropping. Even the hash rate, Bitcoin's network strength, began to decline slightly. That decline signaled another warning: miner capitulation. When mining rewards no longer cover costs, smaller miners sell their Bitcoin to stay afloat. Historically, miner capitulation often marks the early stages of the bear cycle. Then came the whale exodus. Between October 5th and 7th, data showed over 200,000 BTC moving from cold wallets to exchanges. Analysts like Willy warned, whales are preparing for volatility, and it won't be pretty. Simultaneously, global liquidity was drying up. The U.S. Federal Reserve hinted at one more rate hike. Treasury yields spiked. Risk assets started to wobble. And as the dollar strengthened, Bitcoin, the supposed inflation hedge, started losing its shine. Even sentiment changed. Crypto influencers stopped posting rocket emojis and started talking about healthy retracements. Fear crept in. Altcoins started bleeding faster. It became clear that this wasn't just a dip. The macro environment, on-chain weakness, and technical exhaustion were converging. Bitcoin wasn't just at risk. It was on the edge of a structural correction. The world just didn't realize it yet. Every crash starts slow and then happens all at once. The first domino fell when Bitcoin lost $110,000 support. Within hours, liquidation bots wiped out over-leveraged positions across the board. Altcoins fell 20 to 30%. Exchanges reported record traffic as retail traders tried to exit positions. Suddenly, analysts who had been bullish all year turned cautious. One report from CoinShares warned of potential supercorrection similar to 2018, when Bitcoin lost 84% of its value in under a year. And just like 2018, fear returned fast. AI-driven bots began shorting Bitcoin en masse. Each sell order triggered more liquidations. Within 3 days, Bitcoin dropped another $20,000. The $100,000 psychological level was broken. Media headlines shifted instantly. What was Bitcoin's unstoppable rise became crypto market meltdown. News anchors asked if this was the end of Bitcoin. But here's the truth. Bitcoin wasn't dying. It was resetting. The problem wasn't the technology or adoption. It was the overconfidence. Retail traders have forgotten that Bitcoin is a straight line upward. It's a cycle of greed and fear, and right now, fear was taking over. Whales continued to sell. Exchange wallets swelled. Derivatives volume dropped 50%. And as panic spread, smaller investors sold at a loss. Even the ETF inflows that once pushed Bitcoin higher started slowing. Institutional money moved to safer assets. By mid-October, Bitcoin was trading near $85,000, down nearly 30% from its peak in just 2 weeks. It wasn't the end, but it felt like it. On forums and Twitter spaces, traders debated, was this the start of the long-expected 80% crash? Or was it just a deep correction before the next leg up? Nobody knew for sure. But one thing was certain. The euphoria was gone, replaced by caution and fear. When the dust settles, clarity begins to return. By late October, Bitcoin found temporary support around $80,000. The panic selling slowed. Analysts began dissecting what happened. And what comes next? One conclusion was clear. This crash wasn't random. It was a product of too much leverage, too much speculation, and too little patience. Every bull market builds on momentum until it breaks. 2025's run was fueled by ETFs, AI hype, and retail greed. It was inevitable that gravity would catch up. But here's where the story shifts. Even after losing billions in market cap, Bitcoin's fundamentals remained intact. The network was still secure. Developers kept building. Long-term holders barely flinched. In fact, addresses holding Bitcoin for over 1 year hit a record high, signaling that while traders panicked, true believers were accumulating. Veteran investors called this the reset phase, the period where weak hands exit and strong hands enter. Historically, it's the perfect time to study, not panic. Analysts predict that if Bitcoin consolidates between $75,000 to $85,000 and on-chain metrics recover, the next sustainable rally could form in early 2026. But the biggest takeaway isn't about price. It's about mindset. Bitcoin has always punished greed and rewarded patience. Those who survive the volatility are the ones who understand its rhythm, not those chasing headlines. And that's why this might be the most important warning ever. Because it's not just about Bitcoin's price. It's about the lesson it keeps teaching. In crypto, hype rises fast, but truth always catches up. So, what do you think? Is this the beginning of Bitcoin's biggest crash, or the setup for the next massive rebound? Drop your thoughts in the comment below, and don't forget to subscribe for our next deep dive, where we'll reveal the 3 on-chain signals that could confirm when the real bottom is in. Stay smart, stay alert, and as always, stay ahead of the markets.